Imagine two people in the same city living under the same tax code. One of them wakes up early, drives to work, puts in 40, 50, sometimes 60 hours a week, and gets a paycheck. But before that paycheck even reaches their bank account, the government has already taken its cut. Federal income tax, state tax, Social Security, Medicare. The money arrives already reduced. Now look at the other person. They own apartment buildings, hotels, office towers. On paper, they're worth hundreds of millions, maybe billions. Their properties go up in value. Rent checks come in every month. Their net worth keeps climbing. And yet, when tax season comes around, their tax bill can be shockingly small. Some years, almost nothing. How does that happen? How can someone own buildings worth more than entire neighborhoods, collect rent from thousands of tenants, get richer every year, and still legally tell the IRS they barely made any taxable income? Before we go any further, this is not tax evasion. This is not hiding money offshore. This is legal. It's written into the tax code. And the wealthiest real estate investors in the world have built entire fortunes around understanding it better than everyone else. Because the real secret is this: the rich are not playing the same financial game as most people. They are playing a game where salary, debt, depreciation, and asset values are treated completely differently. So in the next 20 minutes, I'm going to show you how it works, step by step. No jargon, no fluff. By the end, you'll understand why some real estate billionaires can become richer and richer while paying surprisingly little in taxes. And you may never look at the tax system the same way again. Let's get into it. To understand why the rich pay so little, we first have to understand why everyone else pays so much. Let's say you have a job, a regular 9 to 5. Maybe you make $50,000 a year, maybe $100,000, maybe $200,000. The number changes, but the system doesn't. Every 2 weeks, your employer pays you. But before that money gets to you, the government takes its share automatically. That's withholding. The IRS doesn't wait until April and hope you remember. It takes its piece before you ever touch the money. Federal income tax, state income tax in most states, payroll taxes for Social Security and Medicare. Maybe city tax too, depending on where you live. By the time the money lands in your account, a huge chunk is already gone. And what's left is after-tax money. When you buy a house, you use after-tax money. When you buy a car, after-tax money. When you invest, save, spend, or pay down debt, you are usually doing it with dollars that have already been taxed once. That's the world most people live in. Work, get paid, get taxed, use what remains. The system is extremely good at taxing earned income. Wages, salaries, the money you trade your time and labor for. The clearer your income is, the easier it is to tax. And nothing is clearer than a paycheck with your name and Social Security number attached to it. But the wealthiest real estate investors don't build their lives around paychecks. They learn something most people never get taught. The tax code treats income from labor very differently from wealth built through assets. And once you understand that difference, the whole game starts to change. Here's the first shift you need to make. Wealthy real estate investors don't optimize for income. They optimize for ownership. A billionaire who owns 10 apartment buildings does not need to pay themselves $1 million salary. In fact, that would be one of the least efficient things they could do. Salary is one of the most heavily taxed forms of money. So instead of taking money as wages, they build and control assets. Real estate gives them 4 powerful things at the same time. It produces rent. It can rise in value. It can be used as collateral for loans. And it gets some of the most favorable treatment in the tax code. The key word is unrealized. When your paycheck hits your bank account, the income is realized. It exists. It's taxable. The IRS can see it clearly. But when a building you own goes from being worth $50 million to $80 million, that $30 million of new wealth is unrealized. You are richer. Your balance sheet is stronger. Banks will treat you as wealthier, but unless you sell the building, the tax code generally does not treat that gain as taxable income. Let that sink in. You can become $30 million wealthier on paper and owe no tax on that gain that year because you haven't sold. That is the foundation. Wages are taxed when they appear. Asset appreciation is usually taxed only when you cash out. And as you're about to see, the wealthiest investors structure their lives so they rarely need to cash out at all. But that raises the next question. If they're holding the building, they're still collecting rent. Rent is income, right? Shouldn't that be taxed? Yes. But this is where the first major tool comes in. This is where real estate starts to feel almost unfair. Let's talk about depreciation. In the real world, a great piece of real estate in a strong location often goes up in value. Cities grow, land becomes scarcer, rents rise, demand increases. Economically, the property appreciates. But the tax code looks at the building differently. To the IRS, the structure itself is wearing out. The roof ages. The plumbing gets older, the elevators, the wiring, the HVAC system. All of it has a lifespan. So the tax code allows the owner to deduct part of the building's value every year as wear and tear. That deduction is called depreciation, and it can be massive. Let's use a simple example. Imagine you own a large apartment complex. Over 1 year, tenants pay you $1 million in rent. That's real money coming in. Then you have real expenses: property management, repairs, insurance, property taxes, utilities. Let's say those cost $400,000. In cash terms, you now have $600,000 left. Money in the bank, money you can use, reinvest, or distribute. If that were salary, you'd be taxed on it. But this is real estate, so now depreciation enters the picture. The IRS lets you treat the building, not the land, but the structure, as if it is slowly losing value over time. Residential rental property is depreciated over 27.5 years. Commercial property over 39 years. That means every year you can deduct a piece of the building's cost as a paper expense. Depending on the property, that depreciation deduction could be $500,000, sometimes more. And with advanced techniques like cost segregation, investors can pull more of those deductions into the early years. Now look at what happened. You collected $1 million in rent. You spent $400,000 on real expenses. You still have $600,000 in cash, but after depreciation, your taxable income might be $100,000, or $50,000, or zero, or even negative. Your bank account went up. But on paper, the IRS may see very little taxable profit. That gap is the magic of real estate taxation. Cash flow and taxable income are not the same thing. For most workers, those two numbers are almost identical. You earn $1, you get taxed on $1. But for a real estate investor, the property can produce real cash, while the tax return shows very little income. And this is only the first layer. Depreciation by itself is already powerful. It can take a profitable property and make the tax bill look tiny. But real estate billionaires don't stop there. They don't just reduce the tax on rent and call it a day, because depreciation solves one problem. It lowers taxable income while they own the property. But it doesn't fully answer the bigger question. How do they actually get large amounts of money out of their assets without selling and triggering taxes? They still need cash to live, invest, expand, buy more buildings, and fund the lifestyle everyone sees from the outside. So how do they pull money out without creating taxable income? This is where the strategy moves into something most people are taught to fear: debt. For most people, debt is a burden. For the wealthy, used correctly, it can become one of the most powerful tax-free tools in the system. Here's how. Here's a simple question. When you borrow money from a bank, do you pay income tax on it? If you take out a $400,000 mortgage, does the IRS say you just earned $400,000? No, because it's a loan. you have to pay it back. The tax code does not treat borrowed money as income. For most people, this rule doesn't feel like a wealth strategy. They borrow because they need to, a mortgage, a car loan, a credit card balance. Then they repay that debt with money that has already been taxed. But wealthy real estate investors use debt differently. They use it against assets that are rising in value and producing income. Imagine an investor buys a building for $50 million. They put money down, borrow the rest, and operate the property. 5 years later, the neighborhood improves, rents rise, demand increases. The building is now worth $80 million. That's $30 million in appreciation. But if the investor sells, they trigger taxes. So they don't sell. Instead, they go back to the bank and refinance. The bank looks at the property and sees a much more valuable asset. So it issues a new, larger loan based on the current value. Part of that new loan pays off the old loan. The rest can come out as cash to the investor. The investor still owns the building. The building still produces rent. But now they have millions of dollars in cash. And the key part? That cash is not taxable income. Legally, it's borrowed money. This is a cash-out refinance. And in real estate, it's a standard move. The formula is simple. Buy the asset. Let it appreciate. Borrow against the higher value. Use the cash to live, invest, or buy more assets. No sale, no realized gain, no income tax triggered. Now compare that to a paycheck. A worker earns money and gets taxed before they see it. A real estate investor's asset rises in value, and they can pull out cash through debt without selling the asset or creating taxable income. Same tax code. Completely different result. But it doesn't stop there. Because not only can borrowed money come out tax-free, the cost of that borrowing can create another deduction. Most people experience debt as a cost. You borrow money, pay interest, and that interest is gone forever. But in real estate, debt can work differently. When debt is used for investment or business purposes, like buying or operating a property, the interest paid on that debt is often deductible. It becomes a business expense, just like maintenance, insurance, or property management. So now add that to the strategy. The investor uses debt to acquire real estate. The properties appreciate. The investor refinances and pulls out cash without triggering income tax. Then the interest paid on that debt can reduce taxable income even further. Debt gives them liquidity. Debt also gives them deductions. That is very different from how ordinary people experience borrowing. A person with credit card debt, a personal loan, or an auto loan usually pays interest with after-tax dollars. There's no tax advantage. It's just expensive. But the real estate investor's debt is tied to income-producing assets. The interest is part of the business, and the tax code often rewards that structure. This is where the system starts to look less like one trick and more like a stack. Depreciation reduces taxes on rental income. Debt lets investors access cash without selling. Interest deductions lower taxable income even more. Each layer makes the next one more powerful. And the reason these rules exist is not random. The tax code was designed to encourage investment in productive assets: housing, commercial buildings, development, construction, capital formation. The idea is that if you reward investors, they build more, borrow more, hire more, and grow the economy. Whether that is fair is a separate question. We'll come back to that. For now, the important thing is this: real estate billionaires are not relying on one loophole. They are using a system where every piece reinforces the others. And we still haven't reached the biggest part. Let's pause and zoom out. Real estate billionaires are not poor. They are not broke. They are not secretly struggling while their accountants pretend they lost money. They are getting richer. Their portfolios are growing. Their buildings produce cash flow. They live in expensive homes, fly private, buy art, take vacations, and keep expanding. The point is not that money isn't flowing. The point is that the tax code does not call much of that money ordinary income. Some of it is asset appreciation, Some of it is borrowed cash. Some of it is real profit hidden behind paper losses. The money is there. It just moves through channels that are taxed very differently from wages. So far, everything we've covered happens while the investor still owns the property. Depreciation, debt, interest deductions. But eventually, there's an obvious question. What happens when they sell? Surely that's when the IRS catches up. Surely that's when decades of gains finally get taxed. You would think so. But real estate has a move for that too. In normal investing, if you sell something for more than you paid, you owe tax on the gain. Buy a stock for $10,000, sell it for $25,000, and you have a $15,000 capital gain. The government wants its share. Real estate works the same way in theory. Buy a building for $10 million, sell it for $25 million, and you have a $15 million gain. But investment real estate has a special tool, the 1031 exchange. The idea is straightforward. If you sell an investment property and use the proceeds to buy another similar investment property within the required time window, you do not have to pay the capital gains tax right away. The tax is deferred, not eliminated, deferred. So instead of selling a $10 million building, paying taxes, and reinvesting what's left, the investor sells it for $25 million and rolls the proceeds into a larger property. The IRS essentially says, fine, we'll wait. And that waiting is the whole game, because there is no limit on how many times this can be done. An investor can sell a $10 million building and roll into a $30 million building. Years later, sell that and roll into a $60 million building, then a $100 million portfolio, then $300 million. Each time, the tax gets pushed forward. Each time, more capital stays invested. Each time, the snowball gets bigger. That matters because a dollar kept invested today can compound. A dollar paid in tax is gone. If one investor pays tax every time they sell and another keeps rolling the full amount forward, the difference after decades can be enormous. Now the stack is even clearer. They reduce taxes on rental income with depreciation. They access cash through refinancing without triggering income tax. They deduct the interest on their debt. And when they trade up into larger properties, they defer the capital gains tax through 1031 exchanges. But there's still one last question. Deferred does not mean forgiven. If they keep pushing the tax bill into the future, don't they eventually have to pay it? Surely at some point, the bill comes due. Not always, because there is one final move. And this is the end game. This is the part that sounds almost too good to be true. But it's real? It's called the step up in basis. To understand it, you need to understand basis. Your basis is basically what you paid for an asset. If you buy a building for $10 million, your basis is $10 million. If you later sell it for $50 million, your gain is $40 million. Now here's the rule that changes everything. When an owner dies and an asset is inherited, the heir's basis is generally stepped up to the fair market value of the asset at the time of death. In plain English, the tax code resets the starting point. Imagine an investor spends 40 years building a real estate empire. They use depreciation, they refinance, they use 1031 exchanges again and again. They stack up hundreds of millions of dollars in deferred gains. If they sold during life, the tax bill could be enormous. So they don't sell. They hold. They borrow when they need cash. They keep the assets. They keep deferring. Then they pass away. Their heirs inherit the properties. But under the step-up in basis, the basis of those properties resets to their market value at the time of death. The mountain of unrealized gain built up over decades can, in many cases, be largely wiped out for capital gains tax purposes. The heirs could sell near that stepped-up value and owe little to no capital gains tax because on paper, there is little gain left to tax. This is why the strategy is often summarized in 3 blunt words: buy, borrow, die. Buy assets that produce income and appreciate. Borrow against those assets instead of selling. Die holding them. So the basis resets for the next generation. It sounds cynical because it is. But it also explains how real estate fortunes can survive across generations with surprisingly little tax friction. The tax bill that was deferred for decades may never be paid in the way most people would expect. And that is the final piece of the puzzle. At this point, it's natural to feel frustrated, maybe even angry. It can sound like the whole system is rigged. But we should be precise. These strategies are not the same as tax evasion. Tax evasion is illegal. What we're talking about is tax planning, using the rules as written, depreciation, interest deductions, 1031 exchanges, step up in basis. These are not secret backroom tricks. They are features of the tax code. Lawmakers created them intentionally, with economic goals in mind. The argument is that real estate investment creates housing, commercial space, construction jobs, property management jobs, and economic activity. If society wants more development, the tax code can encourage people to put capital into property instead of leaving it on the sidelines. There is logic to that. Without incentives, some projects don't get built. Some investors take fewer risks. Some capital goes elsewhere. So the honest version is not simply rich people cheat. In many cases, they are doing exactly what the law allows, and exactly what the law was designed to encourage. But that does not end the debate. It only makes the debate more serious, because the deeper question is not whether this is legal. It is whether the system is fair. Why is a paycheck taxed immediately, while asset gains can be deferred for decades? Why is debt a trap for one person and a wealth tool for another? Why is overtime income taxed in real time while gains on a billion-dollar property can be passed to heirs with much of the tax erased? Those are political questions, ethical questions. People will disagree on the answer. But you cannot have that debate honestly until you understand how the system actually works. And now you do. So let's bring it all together. The average person earns wages. The taxes come out immediately. Their financial life is built mostly on after-tax dollars. The real estate billionaire plays a different game. They build assets instead of chasing salary. They use depreciation to make profitable properties look less profitable on paper. They borrow against rising asset values to access cash without triggering income tax. They deduct the interest on that debt. They use 1031 exchanges to trade up while deferring capital gains. And if they hold the assets until death, the step-up in basis can wipe away decades of accumulated gains for tax purposes. It is not one trick. It is a stack of strategies, layered over years, sometimes generations. And the core lesson is this: the tax code does not just reward making money. It rewards owning assets. If you spend your life trading time for wages, the system taxes you at every step. If you spend your life acquiring assets, real estate, businesses, investments, the system gives you tools most workers never hear about. The wealthy did not necessarily break the rules. They learned which rules mattered. Now, I want to hear what you think. Are these strategies just smart investing, using the tax code exactly as designed? Or are they a giant advantage that lets the richest people push more of the tax burden onto everyone else? Should labor be taxed less? Should asset gains be taxed more aggressively? Or is this the price of encouraging investment and development? Drop your thoughts in the comments. This is one of those topics where the debate is just as important as the explanation. If this helped you understand how the financial world really works, hit the like button. It tells me you want more deep dives like this. And make sure you subscribe, because in the next video, we're going to look at how billionaires use stocks in a similar way, living for decades without selling shares, without taking huge salaries, and without triggering the kind of taxes most people pay automatically. Same strategy, different asset. Once you see it, you can't unsee it. I'll see you in the next one.